Hello, everyone, and thank you for joining us today. My name is Tyler Sanchez, financial planner and research analyst here at the Rice Partnership. I'm joined today by Chief Investment Officer Orest Saikevych. Orest and I will be discussing the current state of the Iran conflict and its effects on global markets. Orest, how's it going?
Fine. Hello, Tyler. Hello, everyone.
Just to get started, I think it would be helpful just to ask what's happened so far.
Okay. In a nutshell, okay, on February 28th, Saturday, uh, the U.S. and Israel launched massive air and naval bombardments of Iranian military and also nuclear facilities, okay? And the goal is a total disabling of Iran's nuclear capabilities. In addition to that, there was another aim mentioned by President Trump, which was regime change in the country, which is kind of an existential risk for the leaders, as was the Ayatollah Khamenei. Uh, he and a number of generals and clerics were eliminated in the strike. However, his son has been named the new supreme leader. The country has responded. They've attacked neighboring country military and energy infrastructure, also hitting U.S. bases in the area. As a result, the Straits of Hormuz uh, or known as SOH by a lot of people, has been effectively closed for shipping. And the Strait of Hormuz is roughly about 20% of global oil supply.
Thanks, Orest. With that in mind, what has the overall effect been on the markets?
Okay. The overall effect has been very mixed. Okay. On the one hand, uh, due to the fact that the U.S. is a net oil exporter, U.S. energy supply is not directly affected. However, other places in the world, especially in East Asia, countries like Japan, South Korea, Taiwan, etc., and also Eastern Europe, those countries are very much affected because they're net oil importers. As far as individual markets are concerned, U.S. equities, we've seen a rotation from some of the recent leading sectors. Okay, overall. Uh, Now, the energy sector had done well. It continues to do well, obviously, because of the spike in the oil price. Utilities have continued their safe haven status. Uh, Information technology, interestingly enough, which had been heavy due to AI concerns, etc., that's reversed and now seen as a safe haven. So that one is certainly looking better. On the other hand, there are sectors that were doing well that have gone down. One of them is consumer staples due to higher food prices seen as a result of oil prices and the indirect effects on things like petrochemicals and fertilizers, etc. There's concern that higher food prices will hurt a lot of the processed food companies. Also, consumer discretionary, in particular retailers. There's obvious pain that U.S. consumers may feel from higher prices, and so they may spend less at the store. A couple of other sectors that have reversed are healthcare and also industrials, which would be affected by higher energy prices as far as margins are concerned, and also if world economy slowed, there'd be a lessening of demand. Uh, as far as bonds are concerned, the oil price spike is seen as inflationary. Um, uh, Due to that, there's probably no Fed cuts seen for the next few months. And so we've seen a 2-year treasury basically go up about 30 bips or 0.3%. The longer dated 10-year treasury has gone up by a similar amount. So bonds haven't really been that much of a safe haven throughout all this. On the other hand, the U.S. dollar has been has hung in there quite well. Gold, because of the fact that the dollar is up and 10-year yields are up, gold has been weaker. Then finally, other commodities, we talked about oil already. Fertilizers have uh, uh, basically gone up in price. Also, chemical gases, but metals such as copper have gone down overall. So that's a little bit about the overall effect that it's been mixed and it's resulted in another rotation overall in the markets.
Thank you. Finally, what are the key factors to watch for a resolution to this conflict?
Okay. One thing to keep in mind is that oil roughly at about $125 a barrel or higher for a sustained period of time is probably an inflection point, meaning that there will be a lot of pain in the global economy, even in the US. Now, we're not there. We're about halfway there. We spiked up to about $115 or so. We're under 100 now, but certainly the $125 a barrel level is something for us to watch closely. Right now, leaders of both countries, the U.S. And also Iran, are taking a hard stance as far as the conflict is concerned. And so a military solution looks like it's problematic, even though we have this certainly the heavy weaponry, etc. The Iranians have countered with missiles and also numerous drone swarms. So a military solution is problematic, and most likely diplomacy would be more fruitful. Now, there are some silver linings to all this. Some ships have recently been going through SOH, the Strait of Hormuz, some Chinese and Indian vessels. And keep in mind that both Iran and China want the SOH to reopen. So there's an incentive there for all parties involved to get an eventual resolution there. One thing the Race Partnership has emphasized is, in portfolios is balanced, diversified portfolios. And we think that approach will weather this conflict well. This is not a time to panic and sell everything. Just like Liberation Day, situation can reverse very quickly. So we urge our clients to have patience. And in the meantime, we will monitor events closely, and if changes are necessary, we'll make them.
Thank you, Orest, for providing us some insight into the current state of conflict. And thank you to our audience for joining us. Take care.
Take care, everyone.